Hey, good morning, everyone. Marty Missouri here, Friday, July 22nd, 2022, with your weekly economic update and a quick stock market snapshot for you. So, our index is getting very, very close to the point where we will be saying that recessionary conditions trump further expansionary conditions going forward. And we're virtually there. 2.22 was our score this morning, and through the life of the index and through the back testing, we've never gone below, I want to say 7 or 8, without ultimately rolling into recession. So we're probably there, folks, which is pretty much the consensus opinion. Of course, the question going forward will be the severity of the recession. Will it be a tough one? Will there be a credit crisis along with it? The deeper it is and the more consequential it is, of course, the lower the level we should be looking for things like equity prices. What I've been reporting to you recently about the overall legitimate health of the consumer and the consumer's actions of late versus their words would suggest at this moment that you could have hope that it's a relatively soft, by historical comparison, recessions, and that fosters interesting dynamics around the market and where we bottom and how deep it gets and so forth. The inflation problem remains a problem, and so the Fed is going to be intently focused on, of course, for a long time going forward. And with a softening economy, we will see inflation roll over. If they're committed to their 2% target, then I think it's going to take a uglier, deeper recession than what consumer strength might otherwise dictate to get there. I'm wondering, in fact, I'm sensing, and I don't hear other people really talking about this, that we may see them as inflation begins to come down and as financial markets perhaps react to what really should be the next leg, and that is earnings, corporate earnings coming down more so than what Wall Street has been expecting. And I get that Wall Street is looking at the consumer and saying, earnings may very well hold up, and that may be true. However, if we do have a recession and earnings come down like they tend to during recessions, then I think the Fed will be thinking about easing off of that commitment to 2% inflation going forward. I honestly don't think that's doable with all the structural factors that we've been pointing to for the last couple of years. So anyway, lots to pay attention to, lots to assess, research, analyze, and so forth going forward. As of right now, looks like recession is imminent here in the US. Okay, so now that said, I'm going to show you a handful of inputs like I always do, but I'm going to start with the ones that don't look so bad, like retail sales. Remember, we were up 8.5%. Of course, inflation was up 8+%. So that was just people responding and paying higher prices. Interesting commentary a week or two ago from Home Depot. Fewer customers, but the ones who are coming in are spending a lot more money. So that speaks to what I'm talking about, of this being a nominal statistic that needed to go up by 8% if indeed consumers are still out there spending. That just means they're actually paying those higher prices. According to Home Depot, yes, but fewer people paying higher prices. So interesting. We showed you this already. But what I want to show this week is we also track the Red Book weekly number, and that's looking better, kind of consolidated in here, and it was up 14.6% annualized last week. So that is a positive, certainly, and supports that kind of maybe softer recession thesis. Commercial and industrial loans, again, these are loans that companies take on to do presumably productive things. Look at that jump. I mean, that's just not something you tend to see, right, as we're in or leading into recession. So that is contrary to that recession narrative. Truck tonnage, actually picked up. Something else, again, inconsistent with what you tend to see during and leading into recessions. Rate of change 2.7%. But of course, we have these anomalies, right? We locked everybody down, gave them all a bunch of money. So we're seeing some opening up of the supply chain. So maybe that just makes sense in terms of recovering from these real distortions and I would say misallocation of resources for quite some time. And when we look at the stock market signals, sorry, this one's really busy, but if you can see what I'm doing down here, Actually here, these last three are your defensive sectors: healthcare, utilities, and staples. Over the last month, they're all underperforming the S&P 500, right? So rotation a bit, maybe out of the defensive things. Industrials outperforming. Um, Consumer discretionary outperforming the most of all of them. Financials actually right there performing with the S&P. In fact, it was over 100 when I scored this earlier. And then tech scoring a little better than the S&P. Tech scoring better than the S&P, though, is not necessarily something that suggests the economy is in good shape, but certainly consumer discretionary and industrials are. So this didn't go positive, but it went from a negative to a neutral. Now for the not so good stuff. Bad stuff, actually. Mortgage purchase apps really rolling over. Had to take that from a neutral to a negative. Rate of change, again, lower by 7%. So mortgage apps, definitely a negative signal for the state of the economy. I already did this on the written blog, so we'll just run through. Recall the other day, talked about single family starts, housing starts, single family permits, right? Not a good look for the economy. And then last but not least, this one I have to say, folks, is one of my favorite indicators, so this one probably bothers me the most. The ratio between leading economic indicators, right? These are the ones that give us a feel for what's happening going forward versus the ones that give us the signal for what's happening at the moment. When this rolls over, leading indicators are giving way to coincident indicators, right? Now, it's not like it rolls over and then we're right on top of a recession. There's a lag, right? So this was, a good 1+ year lag, almost 2-year lag. This year and a half lag. Rolled over, came back, rolled over here about 6 months before recession. Had some false signals in here. These were those mid-cycle slowdowns that I thought we might be facing up in here. But I'm not thinking that now. I am in the recession camp at this point. Question now is, how deep and how bad is this recession going to be? Okay, folks, so that's probably all I need to do right now on the economic or the macro landscape. Of course, during the week, I'll throw in statistics as they come up and continue to talk about our view and what we're seeing and how it's impacting our assessment and our theses going forward. Okay, so the S&P 500, starting with the hourly. We'll just do the hourly and the daily. I did the weekly and monthly on Wednesday, and nothing's changed in the looks of those two. So folks, recall that I was pointing to this 4,000, saying that we may get there, but it's probably going to give us some really tough resistance. Peaked above there this morning, but it's really giving way right now. As I speak, the S&P is down 1.25%. And remember I said that if we roll over here, then we're going to have a really ugly look because we're going to have a bearish divergence. Already had that on the RSI, getting that now on the MACD, on the hourly chart. So you have what in our view is something the bulls really don't want, is you have a rising wedge and you have growing negative divergences here. You break through that wedge, you could see some momentum to the downside. Again, 4,000 met with some pretty stiff resistance. If we come back today and we break above that, particularly with the dynamics around options and what options dealers are going to have to do, you could see a pretty swift, momentum-fueled upshoot from there. 3,900 looks like pretty good resistance. You break down below that, and you could see us careen down to 3,800 really, really quickly right in here. So I'm not making any predictions there. I'm just telling you the setup suddenly looks not good on a real short-term basis. And then on the 1-year daily chart, this is the one that was really looking constructive, right? This is the one that I said I'm skeptical about. I think earnings season is going to bring some unwelcome surprises. And but I did say that technically speaking, it was looking very compelling. And frankly, it still does, except now we do have a negative divergence for sure on the RSI. This is going to have to really begin rolling over, and then we'll have one. Looks like it's almost a foregone conclusion on the MACD. And then you're going to have a situation where you have higher highs and you have the bearish divergences, which basically says odds begin favoring a sell-off. One thing that's encouraging about all this, and I pointed to this the other day, is that the S&P broke above the 50-day moving average 1, 2, 3 days, tested it yesterday and bounced off of that. So that's at about 39, it's 39.19. So that'll be real interesting to see. We're at 39.53. So we break down through there. Remember I said nothing worse than a failed breakout. So we break down through there and then through this trend line. Yeah, you could see some momentum bringing this thing lower. I said recession begins to paint a little different picture, but we are seeing other data that maybe supports that this doesn't have to be your 40-50% decline in stocks. So those are stories that are yet to be told or remain to be seen. And by the way, we didn't wait for a recession to come before we started adding treasuries to the mix, increasing our exposure to the more defensive sectors and so on. Looking at our core portfolio right now, we are capturing a whole lot less than what the stock market is delivering today. And, but again, we have a lot more than just stocks in there. Things like our treasuries are just really helping out. And then, of course, we're doing the hedging and so forth. But, folks, as you've noticed, we're managing a globally macro-driven portfolio. We talk a lot about the stock market because that's on everybody's minds. And it is a lot of what we're in. So this is important stuff to continue to pay attention to. Our job here is to recognize the trends, be well positioned for what we think is a lot of opportunity. In fact, I think that's what you might call a target-rich macro environment, but we got to get through all this stuff that's going on in the meantime. And just eyeballing this before I close, recall just the other day I pointed right here, I drew a line right there and said we've got that gap to fill. But I just didn't see us breaking above it. But if we do, and that's still very possible, then we could gain some momentum. Right now it's falling off right on that line that we drew, and if you look at that little wick on the candle, pretty much captures that. So you can almost call it done, gap filled, as they typically do, and that may be all she got. So you had the 4,000 resistance plus the top of that gap, some Fibonacci lines here that if I drew them, that draw right on that point as well. So just a lot of resistance. We'll see how this all plays out, and if some money doesn't come in and push us above that by the end of the day. Right now it's not looking like it, but of course if I had a dime for every time the market surprised me over the last 38 years, I would have a room full of dimes. Anyway, thank you folks as always for watching and listening. Hope you have a wonderful weekend, and talk to you again soon. Take care. Bye-bye.